Welcome to our CFP exam prep discussion on Section 1035 exchanges, a critical tax provision that every financial planner needs to master. Today, we're diving deep into policy exchanges, specifically focusing on life insurance and annuity transfers. Let's break down Section 1035 of the Internal Revenue Code. This provision enables clients to exchange certain insurance contracts without triggering immediate taxation. Think of it as a specialized version of a 1031 exchange, but specifically for insurance products. Understanding the permitted exchanges is crucial for the exam. Here are the allowable tax-free exchanges. You can exchange a life insurance policy for another life insurance policy. You can exchange a life insurance policy for an annuity contract. You can exchange an annuity contract for another annuity contract. However, and this is where many test takers make mistakes, you cannot exchange an annuity contract for a life insurance policy. The rule of thumb is that you can always move up in flexibility but not down. Let's walk through a practical example. Your client has a whole life policy with a cash value of $100,000 and their cost basis is $60,000. If they surrender the policy, they would owe taxes on the $40,000 gain. However, by using a 1035 exchange to transfer to a new life insurance policy or annuity, they can defer that tax liability and maintain the original cost basis. A common trap question on the exam involves partial exchanges. The IRS allows partial 1035 exchanges of annuity contracts, but not life insurance policies. The entire life insurance policy must be exchanged to qualify for tax-free treatment. Here's another critical point that often appears on the exam. The owner and insured on the new contract must be the same as on the old contract. Any change in ownership will disqualify the tax-free treatment. Additionally, you can't exchange multiple policies for a single policy or vice versa while maintaining tax-free status. Students often misunderstand the timing rules. While the exchange itself is tax-free, if the client withdraws money from the new contract within 180 days of the exchange, it could trigger taxation and potential penalties. The IRS implements this rule to prevent abuse of the exchange provision. Another frequently tested concept is the impact on basis. In a 1035 exchange, the cost basis of the old policy transfers to the new policy. This means if your client later surrenders the new policy, the taxable gain calculation will use the original cost basis. Let's address some common exam mistakes. Test takers often forget that modified endowment contracts can still qualify for 1035 exchanges. They also mistakenly believe that term life insurance policies can't be exchanged. While term policies typically have no cash value, they can still be exchanged under Section 1035. The most challenging questions often combine 1035 exchanges with other concepts like divorce or business transfers. Remember that if a policy is transferred incident to divorce, it's not a 1035 exchange, but rather falls under Section 1041. As you prepare for the exam, focus on understanding not just what exchanges are permitted, but why they're allowed. The rationale is that these exchanges represent a continuation of the investment rather than a disposition. This understanding will help you answer more complex application questions that might appear on the exam.